In every business, transactions don't just happen. They're recorded, verified, and supported by documents. These documents create a paper or digital trail that shows what was agreed between the buyer and the seller. They confirm what was ordered, delivered, and paid for, and help both sides track progress, check accuracy, and sort out any issues if something goes wrong. The purpose behind them is to keep transactions transparent, accurate, and traceable. Let's look at the main documents used when businesses buy and sell goods or services. A price quotation is usually the starting point in a sale. It's a document prepared by the seller that lists the items or services offered, along with the prices, terms, and conditions. It gives the buyer an idea of how much something will cost before they decide to place an order. Purchase order. Once the buyer decides to go ahead, they send a purchase order to the seller. This document confirms what goods or services are being ordered, the quantity, and sometimes the agreed price. The invoice comes from the seller once the goods or services have been provided. It's an official request for payment and includes details such as what was sold, the date, the total amount, and when payment is due. The invoice forms a key part of a company's accounting records because it shows what income is expected. Goods received note GRN. When the buyer receives the goods, they issue a goods received note, often called a GRN. This document confirms that the items ordered have arrived and are in good condition. It's used to check that what was delivered matches the purchase order and that nothing is missing or damaged. Credit note. Sometimes mistakes happen. Maybe the wrong goods were delivered or some items were damaged. In such cases, the seller issues a credit note. A credit note reduces the amount owed by the buyer, correcting the original invoice. It's a way to show that the seller has accepted the return or the adjustment. Remittance advice. When the buyer makes a payment, they often send a remittance advice. This document tells the seller which invoices are being paid and the amount of each payment. It helps the seller match incoming payments to the correct invoices, especially when there are multiple transactions. Cash receipt. Finally, when payment has been received, the seller provides a cash receipt. This is proof of payment. It shows that the money has been received and the transaction is complete. Cash receipts are important for both the buyer and the seller's accounting records.